Ladies and gentlemen, welcome to Entrepreneurial Finance, Debt Capital. Is it possible for a founder to obtain debt capital? Is it possible for ResearchGate to get some money from Deutsche Bank or Commerzbank or all the others which you can see listed here? Well, actually, all those banks wanted to be part of the new economy in the year 2000 and they tried to provide something. However, they burnt their fingers and now they stay away from these companies, which you can see on the left side. Is there a reason for that? Is there a reason why founders do not get debt capital? Well, let's look into the process of obtaining debt capital a little further and try to understand that. First of all, debt capital has advantages for founders. If you can get it, your influence basically stays unchanged. If you look at Mark Zuckerberg saying, I want to remain in control over my company, the easiest way to do that is if you have debt capital, because there's no voting rights associated with debt capital. There's no profit share. If you're making high profits, you have to pay interest rate. That's it. That's the magic of leverage. So debt capital might be of advantage, however, also of disadvantage, because if you do not make money, how do you want to pay interest and how do you want to repay debt capital if you're not able to do that? And honestly, interest rates are always fixed, even in the negative case. So if your business develops negatively, you go bankrupt because you have debt capital. You might have to give securities, highly overrated. Let's get to that in a second. And actually, the main aspect is the willingness of banks to extend loans is very, very limited. Why is that? Well, we can look at that chapter from like the process perspective of obtaining debt capital. So you as the entrepreneur, you'd like to get debt capital. So you go to the bank account, your bank shelter to the guy sitting there, you know him, it's your relationship manager, say, I would like to get 1,000 euros. Well, you probably get that. I'd like to get 100,000. It's going to get more difficult. In all cases, what's he going to do? He's going to want to have papers from you and he's going to give this paper to the so-called credit analyst. And the credit analyst, he looks at the papers and he tries to determine whether you're credible. And how does he do that? Well, actually, he has basically 4 criteria he bases his decision on. It's the financial condition, the account management, marketing competition, and management competency. So let's look at these 4 criteria a little more closely in order to understand if you as an entrepreneur, if you as a young company can obtain that capital. Because if we look at that more closely, what happens is financial conditions. Are your financial conditions good? Well, you just started your business, you're making losses. Does it mean good financial conditions? Certainly no. Second thing, account management. You just started your company. You just opened your account. You do not have a history. So can you show good account management? Probably not, because it's just missing data. Thirdly, marketing competition. Well, that can be interesting. You might be positive there. However, if you have fast-growing markets, banks always see the risks in there. However, that might work. And last but not least, your management competency. You're a guy out of school, or you like Mark Zuckerberg, you quit Harvard and say, now I need bank money in order to start Facebook. Well, never. No management competency. Harvard dropout? Well, should anyone give him money? Well, different story, but banks don't do that because they don't see the management competency. So what's in there, if you look at the 4 conditions or 4 criteria, maybe you can fulfill 1 and 3, you always have problems with that. You might say, okay, no problem, I have securities. Securities are thought to be highly important, but in fact they are not. Banks say we are a bank, not a pawn shop. banks want to deal with money, not with securities. The worst thing happening is that they don't get the credit, but the securities. Don't get the money, but the securities. Then they have to sell the securities in order to get back their cash. This is always associated to some work. And banks don't want to do that because this is not their banking business. So management of securities for banks is highly expensive. And this is why you might have a better so-called credit risk factor, adding the 4 conditions plus securities. So you might upgrade your credit risk factor with securities. However, still careful. Normally it's overrated, so remain by not getting any money, even if you have securities, because banks do not appreciate having securities. So how do you deal with banks then? Well, actually, banks are important because you need them for your bank account. So that is why you have to, or you might build a relationship to a bank, open your account, maybe select that more carefully because, and this is the main part and the most important point, there are public assistance programs you can only get if you have a bank helping you getting that. So if you select your bank carefully, it might especially be the one who can help you best in public assistance program. And there is a second point to that. If your company grows, and even if you're making money, normally it means you need more working capital. Then if you have a good relationship, especially to some local bank, you might easily get a higher credit line because they understand what it means if a company grows and the need for more working capital. If not, if you have an online bank, if there's no one you can talk to, the probability that these people understand your situation might not really be high. So this is why you need banks. This is why you should carefully build a relationship, carefully select the bank, start building the relationship by opening an account, and do not expect banks to put in debt capital into your company if you do not make money. I mean, honestly, if you bring your money to the bank, you want to get it back. You don't want the bank to give it to someone who's not able to give it back and might have some securities nobody wants to have. So this is the situation which you face with bank money. Banks are important for you. Build the relationship. However, don't expect them to give you some debt capital.